Why has tech turned around the way it has over the past week or so, or maybe longer?
Tyler, good to see you this afternoon. Well, you've seen the return of mega cap technology over the last 4 weeks, and it's really because we're seeing a pullback in yields. And that's been the story, Tyler. So a lot of positioning and rotating between different styles and strategies. And I think if you're doing that, it might be somewhat frustrating. Tyler, so far year to date, S&P value is up 14.7%. S&P growth is up 13.3%. So while everyone tries to struggle and debate between growth or value, maybe the right answer to that question is yes.
Rob, tell me why. Just explain in sort of freshman economics terms why technology stocks, why growth stocks are as sensitive as they are to rising bond yields. What is the connection there?
It's all about discounting that longer-term growth at a higher interest rate, which impacts valuation, Tyler. So that's really at its core, that's what it's about. But when I think about markets in tech, it's been a seesaw market. 2 weeks ago, defensives led. Last week, the cyclicals led. And then today, again, the defensives are leading. And tech's really a new defensive. When markets get tough, I think people run to the names they know. It's impossible to predict right now, and it's hard to find attractive assets. Valuations are full across the board. And so with markets at all-time highs, I think we're vulnerable to surprises from a policy perspective. And when you look at what might be the biggest surprise, it's really what the Fed does. And the Fed has told you that they're going to pivot a little bit and they're going to be a little more hawkish, but it's relative to how hawkish they need to be. If they have to come early, I think markets are not going to like that. So we are expecting some near-term volatility, and we have a barbelled approach where we have these quality growth names, and you see that they've been working episodically, and certainly over the last few months, the quality growth. But we also have the cyclical bet on, because we believe that the reopening of the economy is going to overpower all these risks we see. Earnings are good, and when people re-engage, we think they're only going to get better.
Did I hear you say, Rob, that tech is big tech is the new defensive, or is a defensive?
Quality, familiar tech is the new defensive.
Like
Tyler.
Microsoft, which all of you own. Tiffany, tell me why you see such opportunity and are so committed to Microsoft.
Microsoft and big tech. I would kind of put everything into that category, and really kind of keeping, Tyler, in line with this theme of kind of tech outperforming, but really, the market hitting all-time highs, last week, and just kind of continuing to push forward. And I'm definitely looking at that for two reasons, and I think that the current conditions have all the right stuff to support this, right? So the one thing is the valuations are getting slightly better. I'll take you back to kind of 2020 when we were all having these conversations about overvalued stocks. And so one thing that was going to be key to kind of continue the upward momentum of stocks coming into 2020 was that earnings would have to justify valuations to support that growth, especially with these tech stocks. And so now we're seeing kind of forward earnings increasing. So the expectation for the S&P 500 is almost double what it was at the beginning of the year. We have earnings increasing at a faster pace than the market. So valuations are improving a bit. The other thing I'm looking at is corporate spreads, right? So which sometimes can act as a leading indicator for stock prices. So, certainly it can give us some idea of the overall economic health. And so last week, high yield bonds hit their lowest point since 2008. So, but there is one caveat, right? So I'm usually very bullish on tech and especially growth stocks. But the one caveat is that we haven't had a correction close to, 10% since September of 2020. So we're a bit overdue. I don't think that it's a reason to panic, but I just want investors to kind of keep that in mind. And not get too excited, but stay invested and look for those opportunities to buy the things that they have conviction around, especially those growth stocks on the dips. Because I do think that we're going to see some volatility.
And Steve, we haven't had a 5% correction in a good long time as well. It's been a very quiet, peaceful market here for the first half of this year. You also like technology. You also like Microsoft, and you see large cap tech as set up for further gains. Explain your stance.
Yeah, first of all, I want to address your first comment and advise you to expand your sampling base of Instagram accounts.
Okay, I will.
Moving on from that.
Me too.
There's
Tyler,
more fun to be had elsewhere, I guess, is what they're saying. Rob?
Yes. Sampling of one is never any good.
Go ahead, Steve.
But here's how I'm looking at the market in terms of technology. Not all technology is created equal, and Rob's tutorial on why rising interest rates are an issue for tech applies to the tech that use the DCF, discounted cash flow analysis, as a model, not the other tech. Now, I've consistently made the case that reasonably priced technology names valued on the here and now, not some 5, 10, 20-year point in the future, are cheap, because they are growing, as Tiffany pointed out, much faster than the market. And that's Google, that's Facebook, that's Skyworks, that's Qualcomm. Big discounts to the market in the latter two.